Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 340 on September the 13th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on NIO Inc, C3AI Inc, and Delta Airlines, and we discuss three new trades on Iris Energy, Verizon Communications, and Carnival Cruise Lines. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the video tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets recovered nearly all of last week's losses. The Dow Jones Industrial Average picked up 1,048 points, closing at 41,393 points. The S&P 500 index grew 217 points, ending the week at 5,626 points. And now it's time for the topic of the week. Topic of the week this week is leverage. This is one of those topics that people often speak of as something to be afraid of or fear. In finance, when we speak of leverage, oftentimes we're talking about debt. That's not the case when we're discussing options and futures. When you purchase stock, you have to buy the shares up front to benefit from the price movement of the stock. You can buy shares on margin, which creates a leverage effect, but again, that's simply debt. You have borrowed the money from your brokerage to buy the shares with the promise to repay it. When it comes to options, the leverage scenario is actually different. Rather than hypothetically, let's look at an actual example. If I wanted to invest in NVIDIA, I could buy 100 shares of stock for $11,910 right now. At the time, the price was $119.10 per share. Or I could control 100 shares of stock by paying $340 for the September 119 call option. So I can spend $340 to control an asset worth nearly $12,000. That's leverage. I could purchase 35 September 119 calls for that same amount of money and control 3,500 shares of stock. The leverage enjoyed by options does not come for free, of course. After all, if the option finishes out of the money, then it expires worthless and you'll lose all of the money you paid for the option. Of course, you could be more conservative and buy a deeper in the money option like the September 110 call, which can be purchased for $975. Even in that scenario, spending roughly $1,000 is better than spending roughly $12,000. I could buy 12 of those options and control 1,200 shares rather than simply buying 100 shares for the same amount of money. When I mention controlling shares, I really mean that your position will profit as if you own 100 shares per option. You also have a natural stop built in because you can only lose what you pay for the option. Now, I've traded contracts in the past on products like crude oil and the S&P 500 index. Trading futures, you are posting margin rather than buying an outright piece of paper. From the moment you execute the trade, your position goes up and down based on the value of the underlying futures product. Right now, you would pay roughly $6,500 for a crude oil futures contract that profits like owning 1,000 barrels of crude oil. Crude oil is trading around $69 per barrel at the time of this writing, so $6,500 allows you to control an asset with a notional value of $69,000. That's better than 10 times leverage. There's no limit to how much money you can lose when trading futures other than taking the contract all the way down to zero. As unlikely as this is, that should still scare most of you away from trading futures contracts. When trading options, the most you can lose is the amount of money that you paid for the option. The November 67 crude oil call option will cost you $2,000. That is significantly less than the $67,000 worth of crude oil that the position will benefit from as it moves in price. So when it comes to leverage, options truly are exceptional, even relative to futures. Not only can you benefit from larger positions with less money, but you also have a clear means of limiting your loss. That means you can enjoy the benefits of leverage and still sleep easily at night. That's why I always discuss risk on this show. If you don't manage risk, you're gambling, plain and simple. It's important to understand the leverage that these instruments give you so that you can size them accordingly and profit using less capital. That's the goal, right? So that's it for the topic of the week. With the market being up so strong this week, it should be no surprise that all of last week's trades finished profitably. So let's go ahead and get started with the covered call. Last week, we looked at the covered call on NIO Inc. That's N as in November, I as in India, O as in Oscar. At the time, the stock was trading for $5.03 per share. I looked at buying stock and selling the September 5.5 call at 11 cents, hoping for a return of 11.53% in 2 weeks. Well, shares of NIO grew 50 cents, ending the week at $5.53 per share. The call option we sold gained 14 cents, leaving us with a net gain of 36 cents on the week if we were to close the trade out immediately. Now, with only one more week until expiration, it makes total sense to hold this trade one more week to capture the full expected profit, assuming the stock remains above $5.50 per share. If not, we'll still be left with the option of closing this position out manually or simply selling another call option on the shares that we own with a later maturity date, of course, after expiration. You would want this September call to expire worthless if it goes out of the money. So this trade has worked out as planned so far. No adjustments are needed. Next up, we have the credit spread on C3AI Inc. Symbol A as in Alpha, I as in India. At the time, the stock was trading for $21.29 per share. I looked at selling the September 20.5 put spread at 17 cents with a maximum possible loss of 33 cents per spread. Now, shares of C3AI rose $1.71, ending the week at $23 per share. That out of the money put spread that we sold is now even more out of the money, which means we made money on this trade this week as well. The spread can be bought back for 12 cents right now, but we still stand to keep the full 17 cents that we collected when we sold if the stock expires above $21 per share. Now, we'll need to keep an eye out on stock this week before expiration, but so far so good on this one too. Nice trade. And our final trade from last week was that debit spread on Delta Airlines, symbol D as in Delta, A as in Alpha, L as in Lima. At the time, the stock was trading for $42.04 per share. I looked at buying the September 42 call spread for 32 cents, which could give us a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Well, shares of Delta jumped $3.16, ending the week at $45.20 per share. The in-the-money call spread that we bought is now deep in the money, and just as with the other spreads or the other trades we mentioned, we are on a trajectory to finish fully in the money on this trade as well. So that would allow us to capture the full 56.25% return that we planned on at the start of the trade. So no adjustments are needed on this one either. Nice trades overall. I love it when it all works out. Now, we are 1 week away from expiration for all monthly options in September. All new trades today and for the coming weeks will use the October 18th expiration date for monthly options in October. So let's go ahead and get into the new trades. We're going to start off with a covered call on Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. The stock ended the week at $7.56 per share. I'm looking at buying stock and selling the October 8 call at 80 cents, hoping for a return of 16.4% in 5 weeks. Now, you enter this trade by buying stock for $7.56 per share and selling the October 8 call at 80 cents. This trade makes the most money if stock prices finish above $8 per share. The break-even price on this trade is $6.76 per share. In real terms, the stock purchase would require $756, and you'll collect $80 for selling the option. Next up, we have a credit spread on Verizon Communications, symbol V as in Victor, Z as in Zulu. The stock ended the week at $44.42 per share. I'm looking at selling the October 44.43 put spread at 32 cents, which could give us a maximum possible loss of 68 cents per spread. Now you enter this trade by selling the October 44 put at 89 cents and concurrently buying the October 43 put for 57 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $44 per share. The break-even price on this trade is $43.68 per share. In real terms, you'll receive $32 per spread that you sell and have $68 at risk. And then our final trade on the week is going to be a debit spread on Carnival Cruise Lines, symbol C as in Charlie, L as in Lima. The stock ended the week at $17.25 per share. I'm looking at buying the October 16-17 call spread for 63 cents. That could give us a maximum gain of 37 cents, or that's a 58.73% return in 5 weeks. Now you enter this trade by buying the October 16 call for $1.91 and concurrently selling the October 17 call at $1.28. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $17 per share. The break-even price is $16.63 per share, and in real terms, you'll pay $63 to enter the spread, and your maximum gain is $37 per spread. So that's it for this week's show. I'm going to be adding a couple of new trade types in the coming week's shows. So I'm just setting things up right now. So we'll be adding to the trade examples on the show. So I really do want you guys to have a full breadth, a good idea of how I use options to make money and how you too can use options to make money each and every month, sometimes each and every week. And of course, if you guys ever have questions or are interested in coaching, getting a little extra help, shoot me an email. You can reach me. I gave the email earlier. You can always just go to the weeklyoption.com website and choose the contact tab and leave me a message in there too. I'll get that one too. So thanks so much for listening to the show. Thank you for all of you who share this with your friends and family who also love options. And as well, thanks for those of you who reach out to me each week. I love hearing back from you. So I'll get back. I do owe a few of you emails, so go ahead. I return each of those emails personally, so feel free to reach out to me. You'll reach out to me directly, not an assistant, and I look forward to hearing from you. All right? Have a wonderful weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.